Hello, everyone. Welcome back. I'm Vince Rocco in New York, where the state of our industry is questionable. So let's get right to what everyone is talking about. Well, much of the nation faces a pronounced housing cooldown characterized by rising inventory, longer days on market, and a waning buyer urgency. New York City continues to resist the trend. Its resilience stems from a combination of structural scarcity, international appeal, and the steady return of high-earning professionals who anchor demand in key neighborhoods. Limited new construction, especially in Manhattan and Brooklyn, keeps inventory tight even as other markets overflow. But at the same time, New York City's luxury market and ultra-luxury segments remain persistent by global investors seeking stability, safe haven assets, and long-term value. And in the strong local job market, continued corporate relocation, and a surge in all-cash buyers insulated from high mortgage rates. The result is clear. While the rest of the country cools, New York's housing market continues to heat up on its own terms. And here on set with me today is Jared Antin from Brown Harris Stevens. He joins me now to discuss, but first, let me welcome my listeners and viewers from across the United States and all around the globe. This is Talking New York Real Estate, so let's go behind the headlines and inside the state of our industry.
Hi, it's Stephen Bailey from Roadway Moving and Storage. Listening to Vince Rocco, you know the right partner makes all the difference. At Roadway, we deliver an experience your clients will love. For specialized services and white glove care, choose Roadway. Want to learn more? Email me at steven@roadwaymoving.com or visit roadwaymoving.com.
Okay, everybody, we are back. So we're going to be talking about a lot of things about the market in 2025. We're going to end the show later on today with a little bit of a prediction and a forecast. But you know what? So many things have gone on in 2025. You know, economic issues, buyer issues, psychological buyer issues, whatever. But we always seem to come out of it somehow in a good way. If you listen to the intro, the rest of the nation is not necessarily keeping up with the demand or the activity that we are here in New York. And we're going to explain all that and break it all down. With me today is Jared Antin. He works here at Brown Harris Stevens, managing director. And, you know, no one better to talk about this kind of stuff than Jared because he's got his finger on the pulse and writes great market reports on a regular basis. So, Jared, you know, let me ask you about, you know, the national market, you know, two different realities when we're looking at, you know, New York City, et cetera. Why are we here in New York City, you know, outperforming at a time when so many other markets around our country seem to be softening? And we'll get to the South in a minute, the West in a minute. But why do we seem to be, you know, keeping our head above water? I guess better way put.
I think the short answer is we underperformed for so long, you know, coming out of COVID. So in comparison, you know, we now stand to do better than many of the other parts of the country. There's some good research that was put out. A gentleman by the name of Lance Lambert had released a study this fall, basically looking at what percentage of the housing markets are seeing year-over-year price declines now. So about 105 out of the nation's 300 largest markets are seeing price declines. What's more stark, though, is when you look at a map and you overlay the areas that are seeing price declines versus those that are seeing year-over-year price increases. Because when you line it up, you see that the areas that were hottest during COVID, so Florida, the Southeast, really from Tennessee down through the Carolinas, Georgia, across through Texas, Arizona, and some parts of California, are now seeing price declines. And markets that didn't do as quote unquote well or see as much of a population migration are now doing better than the other places, right? So the Northeast and the Midwest are doing incredibly well now, in part because of population flows, in part because of people seeking areas for a lower price point, because affordability, you know, still is one of the hot topics.
What are some of the biggest false assumptions that people make right now today about the New York City marketplace? With everything said and done, everything you just said, what are some of the, you know, the assumptions that people are making incorrectly when they either coming out from outside the city in, or people who are here and have lived here for years? What are they thinking?
So I think one of the biggest misconceptions is the way that people that are not feeling the pulse of the city every day are indexing the city. You know, if you read the news, if you read the headlines, you know, some want you to believe that it's a crime-ridden, you know, city that's down in the dumps. And that couldn't be further from the truth. Because when you're here every day, or even some days, you feel the pulse, right? This ability to just feel the energy that is so unique to New York, whether that's the horns blaring, the traffic, or just the energy on the streets. And to me, I have seen that energy come back in a larger wave than I can recall since before COVID, starting this this fall. It was like the second that Labor Day passed, the city came back, roaring to life. The city's busier, there's more energy. So it's alive and well. I think people here have a number of different opinions on where things are going. We just came through the political contest, and there's a handful of other things that still have to play out moving forward. But I think the biggest important thing is remembering that New York has an incredible international appeal and alluring demand, and there's no other place like it. And that remains, something that so many people want to be able to experience and own a part of.
5 years ago, we talked about during the COVID pandemic and the aftermath, people migrating to the South, wanting warmer weather, good excuse to leave New York, where costs were higher, prices were higher, whatever. Are you seeing a reverse migration these days back to the Northeast, or is it kind of just people went there, staying there, and really have no intentions of coming back? What do you see?
I think it's a little bit of everything. There is certainly some reverse migration taking place. I don't think it's happening in a large enough wave for the mass media to take notice, but it's certainly starting. I think what's also really important before I dive into further on that topic is to remind the listeners that New York City is abnormal because 70%,
you think?
for many reasons, but one of them is 70% of our housing stock is for rent. So of all the available residential properties
70%.
in the city, 70% is for rent, whether that's rent stabilized, rent controlled, free market rentals. Across the board, 70% of the properties in New York City are for rent and only 30% are for sale. So I bring this up because it's important that when you hear that people are fleeing New York, leaving New York, mass migration out, when you have a lease, you're not stuck here. So during the early days of COVID, I used to love seeing, and that's sarcasm, the news channels be able to show everyone's leaving, the city's deserted. Because if you had a lease that was up at some point in those early years of COVID, sure, go back home with your parents, save a couple bucks, go rent somewhere else, right? But the important piece is the people that own real estate here in times of uncertainty or chaos, they don't panic sell. We didn't see an increase in sellers wanting to go and sell their homes. We didn't see prices drop. So the important thing is to remember that there's really no other city in the country that 70% of the housing stock is for rent. And that has drastic effects on population because New York is a transient place. There was a study that was released the other week that, said, I'm making up the stat, but it was something like 50 or 60% of people in New York plan on leaving the next 3 to 5 years. Because again, people move in here, then they move out. It's natural. That's the point. That's part of the reason that we have 70% of the housing stock rental. So that's part of our DNA.
So would you say then, based on that, that the Florida trade is kind of unwinding? I mean, people not really focus. I was talking to somebody actually, and the reason I'm asking, last week I bumped into somebody from Florida, and she had moved down there, I guess 4 or 5 years ago, and said it's almost becoming like a ghost town. And we've heard that before back in the 2008, 2009 financial crisis. And she's like, it's tough. It's tough for the agents down there to sell. There's not a lot of inventory coming on. It sounded very familiar to what we go through sometimes in New York. But she's like, I'm like disenchanted, and I'm thinking very seriously about coming back to New York.
Yeah.
I mean, is that a trend? Really a trend, or is it just a one-off here and there, or few people think the same thing?
So inventory is a really important concept. So I want to sort of bookmark that, and we're going to come back to that in and of itself. The short answer to your question is yes, I do believe that the Florida trade is unwinding. The longer answer is you have to understand the difference between a push and a pull, right? So demand was pulled forward 5 years ago when COVID ensued. It was even pulled forward when the salt tax, was capped in 2016, and then there were some other changes in taxation and legislation. So there's been so many events that have pulled forward demand, meaning that there was some external factor that was motivating people to make a purchase and perhaps make that purchase sooner than they would have otherwise done. And what I mean by that is if someone was retiring, let's say now, or between now and 2030, maybe they accelerated and purchased earlier because they were untethered from their place of work. So they were able to buy that property and retire or move or relocate sooner than they would have otherwise. Then you had the rates increase, and that was a push that deferred the purchase. People said, I'm going to wait to buy until rates dropped. right? Rates have come down a little bit since their peak, but they're nowhere near back to the unrealistic levels of where they were earlier this decade. So to me, I think a lot of the demand for Florida occurred from that population migration because of that push or pull dynamic, because of the untethering from the job centers. People were able to go remote. They're able to move to areas that have lower cost of living, more favorable taxation, better quality of life. You insert whatever word you want. And granted, some employers have relocated there and the jobs have followed. But I think what has happened is, it hasn't been all it's cracked up to be living in Florida. Say what you want about New York politics, Florida has moved equally in opposite direction. So people may be unhappy in either locale, depending on their political ideology. And you've had so many hidden costs that have crept up from taxation, insurance. If you bought into one of these older condo buildings in Florida, after the tragic Seaside collapse, there's been a ton of assessments and depreciation of the value. So you have now fundamentally more sellers then you have buyers in many markets. And that is what has been the biggest precipice now of this price decline versus price appreciation.
You touched on it a minute ago, and I wanted to ask, post-COVID, during COVID and then post-COVID, we went into a very large work from home. People could work anywhere. Didn't matter, where you were living at the time because you were working remotely. How much of that influence is still affecting where people live? I mean, there are still people working from home, but there's been a large mandate throughout this past year with companies saying you got to be in the office or you're going to lose your job. So how much of the remote work is still influencing where people are buying? Are they buying in Westchester? Are they buying in Connecticut? Are they continuing to want to buy down south versus planting here in Manhattan or anywhere in New York City where they used to and going to work every day? Is there still a major work from home effect on our market?
So my belief is that there's a declining work from home culture, right? I think because the larger employers that weren't a remote workforce based company are doing everything in their power to try to get people back in the office, right? And this is where I've said a mild recession is going to bode well for New York City because it's going to get more of the employees back here. And we've been now in this sort of weakening labor market in this no hire, no fire sort of messy middle. And the balance hasn't fully shifted back towards employers yet, away from employees. But if the economy weakens, if the job market weakens, that will do that more. Now, there are certainly companies that grew up in the last handful of years that have a remote first workforce, a remote only workforce, and that's great. And that's probably going to continue irrespective of what happens with the economy because there are certain cost savings for the company to do that. But to me, the largest employers are trending away from remote work in favor of an office, whether they actually believe that boosts productivity or whether they just have way too much money invested in physical real estate that they needed to be used to feel better about that expense. I'm not debating that right now. But I would say that there are people who are remote workers who have a little bit more flexibility to be able to figure out where they want to move. That's why we have seen some increasing demand into markets like the Midwest, into parts of upstate. I had talked about last year, I think I had done this whole research study looking at, what markets I believe would appreciate most in the coming years. And it was all based upon the discrepancy or the delta between the most new job creation and the least housing starts. And two cities came up on the top of the list, Rochester, New York, and St. Louis, Missouri. Two cities that are now topping the list in terms of places that are seeing highest year-over-year price appreciation.
I heard on the news last night that, and I think this number is correct, but I'm not quite sure. Didn't have time to verify it. Almost 1 million jobs lost this year in the U.S. in the entire country. How then does that affect the individual markets? And we'll talk about the West and the Sun Belt in a minute, but how does a job loss of 1 million people around our country affect our housing market? Yes, there are pockets of activity. Yeah, there are pockets of where it's not so busy or whatever. That's a lot of people out of work for a whole host of reasons. We don't need to get into it, but what's your thought on that?
Yeah, I mean, anytime you see declining employment is going to affect the amount of money that people have to spend, right? We already have a concern over the cost of living, cost of housing. It's already become harder and harder for people to enter the housing market, to be able to purchase that first home. Yeah. The discrepancy between those that rent versus own is contributing to this K-shaped recovery that we're in right now. But the important factor is that all supply is not created equal, because a house or an apartment or a townhouse is not the same if it's in one location versus the other if the person's job is not there, or how easy is it for someone to physically pick up and relocate in the search of a job. There's a lot of cost, whether real or not, that come into that factor.
Right. All right, we got to take a quick break. We're coming right back with Jared. No, don't go anywhere. This is Talking New York Real Estate on the More Network. We'll be right back.
I'm Brian Scott Cohen, one of the top loan originators in the country and the #1 mortgage originator at Guaranteed Rate Infinity. Guaranteed Rate Infinity arguably has the most advanced tech in the industry. Our completely digital loan process makes it easy and efficient for homeowners, from a 15-minute pre-approval to the digital application and through closing. My team and I would love to help you get into the home of your dreams.
From residential and commercial closings to litigation, Romer DeBoss is your full-service real estate law firm. We blend big firm knowledge with boutique-level attention, delivering outcomes that exceed every expectation. Contact us at romerdeboss.com.
Okay, everybody, we are back. Jared, let me ask you something. So we talked a lot about, the various marketplace markets out there, before the break. What markets are you seeing the biggest price declines in these days? I mean, where are prices going down, if any?
Yeah, I mean, Florida is getting hit the hardest. You have so many markets there that had so much attention, whether it's Miami, Palm Beach, Broward County, on the west side, Tampa, Fort Myers, all the way up through the Panhandle. So Florida has been hit in part the hardest because, again, there's just not that same inflow, right? The movement of prices is going to be dependent on supply and demand. So if your demand is drying up because you don't have that population migration, and people still are experiencing that lock-in effect of having, a fixed rate of sub 3% or sub 3.5%, it almost becomes too expensive for them to be able to move than just to stay put. So if you reduce that demand, if you don't have, more people moving into those areas, you're then going to have more sellers. I think part of the reason, too, is the markets that are starting to experience drops now had experienced a lot of investor demand. Because anytime a market experiences fairly rapid appreciation, so again, markets in Miami, Austin, even Metro Denver is an example of this, that when you see prices go up, you get that bandwagon effect. You get the people who say, you know what, I can make a quick buck. Let me buy something for a year, 2, 3. Let me see what I can do. You didn't have that same investor effect around the tri-state area because in part prices were already high, and in part our prices weren't going up in the same way. So when you have these people are buying for investment, they're not tied to it in the same way a family is there, and they're not tied to it in the same way as them having that low interest rate that they don't want to lose or give up. So it's easy for them when they see prices to drop to start selling. And that then increases the inventory, which decreases the price. And you have that, again, bandwagon effect to the other end. This is part of the reason that these other markets trade more like a tech stock, and why I have always said New York is more like that blue chip, because we don't have as much investor demand. And when we do, they have significant liquidity in the homes because of our co-op and condo requirements. So again, when times are questionable, they just freeze and stop. So there's no transactions. Therefore, there's a price floor that keeps prices fairly elevated.
We're going to talk about inventory in a minute, but because I heard something yesterday, or I'm going to close with something rather. But so so what you just said, we're not really talking about a crash, right? We're talking more of a little bit of a necessary correction.
Yes.
Around
correct
around the country. I mean, or even here in New York City. I mean, for years and years, I've heard buyers say, well, it's really not the time to buy, even when it's a buyer's market, because, well, I'm waiting for prices to crash. I'm waiting for prices to go down. I mean, I've heard this for years. And I keep saying, guys, the prices are not going to go down. They may correct. They may, level off or whatever, but they're really not going to crash. I haven't seen that.
Yeah. And I love
anywhere.
and this is sarcasm again, but I've been seeing on Facebook over the last 6 to 8 weeks, these, probably AI, sloop that says, home prices are expected to crash 50% in the next 18 months, right?
Right.
And I'm not the only one that's been seeing these, because some of my friends are like, Jared, is this really true? And I'm like, I don't see how that is actually possible. Now, granted, can something catastrophic happen?
Oh, absolutely.
And can they? Sure. But in the realm of what is plausible or possible, I don't see that, because, again, people have significant equity in their home. We haven't done these mortgages like we did in 2008, when we were lending basically anyone with the pulse, and maybe even then some without, money. People are tied in and have more equity. I don't see the bottom falling out, because, again, we maintain to be a supply constrained, and that's not just inventory. I'm talking the total housing stock is not enough to support all of the people that are here or want to be able to have a place to live.
We're going to talk about the psychology of buyers in a minute, but this leads me to a question, that says, what should the buyer, the New York City buyer, think when they see all of these, country national headlines out there? Oh, prices are going down, prices are correcting. What about New York? How come it's not happening in New York? What do you think they're seeing, or what do you think their perception is when they're hearing or reading these headlines? Just like anything else in the news. I mean, good or bad.
I think it's funny, because when prices were going up everywhere, they still said New York was down in the dumps. So if prices are going out everywhere, they expected New York to follow. So everyone wants their cake and be able to eat it too. Mm-hmm. But the reality, and this is probably the most important thing, is New York City moves, well, Manhattan in particular, moves counter-cyclical.
Right.
Brooklyn mirrors the national trend, just with a bit of a delay.
Yeah.
Like, Brooklyn saw a similar appreciation wave after COVID. It was just on a 6 to 8 month delay as soon as people realized that COVID wasn't a density issue. But Manhattan itself moves a bit counter-cyclical, and we're heavily tied to the bonus pool. We're expecting record-setting bonuses on Wall Street this year after a down year last year. So that's going to put a ton of money into the hands of people that want to spend. The luxury market is already doing incredible things. And overall, what's really important is people are buying in our market. We have seen this fall, so the fall market here was the best fall market in terms of contracts signed since 2021, and the second best in 11 years. That's huge.
And 2021 was a boom year.
And 2021 was a boom year. So you got to go all the way back to 2013 and 2014 to have a year that had more contracts signed than the year we just went through. So people want New York City, and I think that's really important.
Isn't that something, though, I've been saying that for years. People want New York City. Yeah. I mean, they want New York City. It's just all these headlines, all these, stories, all these whatever, sometimes put a buyer on the sideline. Let's talk a little bit about inventory, because I'm going to close with something that says, my prediction for 2026 is we're not going to have an interest rate psychological problem. We're going to have more of an inventory problem, or that's what the issues are going to be in 26. What's your 2 cents on that? Where do you see inventory heading as we finish 2025 and we enter into a new era of 2026, whatever that means?
Yeah, so it's interesting, because prices usually, until let's call it 2020, followed demand, right? Now, in economics, price is the basis of the intersection of supply and demand. More demand, same supply, price is going to rise. Less demand, same supply, price will fall. So demand, the amount of buyer activity or buyer energy, was generally dictating the trend, because supply was, for all intents and purposes, a fairly constant for much of the history, right? Did it go up? Did it go down? Sure. But what totally changed now was this whiplash effect on interest rates.
Yeah. In
the past, interest rates would have rose or fallen slowly. And when rates fall, that's great, because it's better for buyers.
Yeah.
And it's fine for sellers, because they could refi or they can move and get a better deal. The worst part for people that own a property is for rates to go drastically higher, right? That affects buyers, because it affects how much they can purchase, and it creates then this lock-in effect for those sellers. Now, if you love your home and you never plan on leaving, then it's amazing that you have that low rate. But if you don't necessarily love your house, or you've outgrown, or you need to move, this presents this sort of conundrum where it may actually be more expensive for you to sell your more expensive, larger house and buy a smaller, house. So it has thrown into a whole whirlwind the usual sort of supply turnover of what happens of buy larger, downsize, and, replenish the housing stock.
Prediction on inventory next year. More of it, less of it, about the same?
It's hard to say. I mean, you see areas. It's going to be a bit area dependent, right? Because if people move to the areas during COVID because they were able to be untethered from their job center, and now they find them needing to be back in an employment center because their job are recalling them or their remote work went away and now they need to try to increase their chance of getting a job, they're going to need to sell and be able to relocate. So you're going to have more inventory in some places and less inventory in other places. And that's going to create this unequal playing field. And this is why you're seeing really two completely polar opposite housing markets. You look at suburban, New York City. So you look at parts of Long Island, Fairfield County, Westchester County, and parts of New Jersey. There is not enough supply on the market for the demand. Even though demand has gone down, supply has gone way down, which has caused prices to still increase. And I think that's the number one thing that most people got wrong, is that they never expected housing prices is still increasing when interest rates rose as fast and as dramatically as they did. What we didn't account for was how much supply would constrict and thereby just force prices higher. So we are seeing this huge disparity between the amount of inventory in the Northeast, for instance, which is why prices are continuing to go higher, and the amount of inventory that's coming up in these other places where you're starting to see prices fall. So you're having this holistic rebalancing effect.
Correct. So from a buyer psychology, okay, after all that said, buyer psychology, and we say from FOMO, fear of missing out, to fundamentals, right?
Yeah.
I mean, it's really interesting. Buyers are no longer pulled forward by ultra low mortgage rates, okay? They are no longer pushed into waiting for rates to fall. So what does that translate to? Are they getting the fact that, rates aren't really going to fall that much, so I better start doing something because I'm going to miss out?
Yeah, I think the expectation that rates would snap back to the low rate where they were was a fallacy that I think after about 2 years of them not doing that, many of us realized that wasn't going to happen.
Not happening.
And then life takes hold. So Vince, I want to let you do the honors. There's an acronym here, that we talk about because people now are generally buying because of actual intrinsic needs or life needs. They're not being pulled forward or pulled or pushed out based upon intrinsic factors. Right. So this is putting some more normalcy in terms of demand patterns where we had this completely abnormal, once in a generation type of demand pattern. So,
but I think you and I agree, though, that the psychology of a buyer these days is that rates are falling.
Yes.
And rates are going down. And when the psychology in a buyer's mind says rates are falling, rates are going down, is that kickstarting a hotter market where people are running out? I always say all the time, to get a buyer, incentive, you got to have the price right, the rates right. They run out the door, they run down the street with their hair on fire, and they can't buy fast enough. Is that what the perception of lower rates or rates dropping actually doing right now in our market?
No, we're nowhere near there. What we are getting away from is the I'm going to wait for rates to drop. So we're getting away from the push out. There's not a pull forward. So we're at a net neutral, right? That's why I say the market's balanced. But people are buying based upon when they need to and when they have the financial wherewithal to be able to do so.
Life needs when life needs.
Exactly. So
Go ahead.
They are of the mindset, though, that we are in a rate declining environment, which is helpful because that's better than a rate increasing environment. So again, they're going to be able to just pull that trigger when they need to. Rates are down about 80 basis points on the headline 30-year fixed average from their peak almost a year ago. Correct. So rates are moving in the right direction. We'll see what the Fed does in their December meeting.
And I think I heard this morning on the news before I came here, the Fed is looking to reduce up to 2 basis points tomorrow.
25 basis.
25
a quarter point, yeah.
Right. 25 basis points tomorrow. Is that enough? Is that going to, really reduce? When we all know, by the way, that when the Fed reduces rates, 25 basis points, 50 basis points, whatever the number is, it doesn't really affect mortgage rates. And we know that. In fact, I was talking to a mortgage broker friend of mine last week and said, hey, listen, last time the Fed reduced rates, our mortgage rates went up.
Correct. Yeah, because it's all priced in.
Again, buyer psychology, What does that do?
Yeah. I think the reality is many buyers aren't as plugged into the daily change of interest rates as we may be.
Correct.
So if they hear that the Fed is cutting, again, big picture, that feels better for them, even though we've said to buyers, like, you know, rates were always lowest before the Fed made that first cut last September, this September. So it's untethered because it's a derivative effect. It's more controlled by the 10-year Treasury rate.
Correct. Absolutely. You know, we talk about, the 5 Ds. I laughed when I read this. The 5 Ds are back as primary drivers. Okay. Death, divorce, diapers, being growing families, babies being born, diamonds, getting married, whatever, and diplomatic or job changes, relocation. You know, this is usually the impetus for somebody to do something, a buyer to buy, a seller to sell. They need to upgrade, downgrade, whatever. As far as the 5 Ds are concerned, I mean, I think this has always been, part of our world here in New York real estate, seemingly back again. So Are these the life things that we referenced before that buyers and sellers are starting to think about? Like, hey, look, regardless of what happens, we got to continue living and we got to continue our housing no matter what.
Correct.
Right?
Yeah.
You're a family person, you need a house to raise your kids in, right?
Correct.
Whatever.
Now, the friction that has been added to that is if you have a 3% interest rate and you can now go and get a 6.2, so you're saying, hey, it's going to cost me now double for my interest rate. People have been putting up with some more pain and not moving on those life needs. But again, as that pain gets greater, as time goes on, and as the gap between someone's current rate and the available rate in the market shrinks, it's easier for them to be able to go and act on that. I've seen stories where, there's people who've gotten divorced and they're literally still living in the house together. In separate, but it is too expensive for them to sell and buy 2 separate places.
I have a pair of friends who are doing the same thing. I'm like, how's dinner? Is that working for you?
One is a 5 o'clock shift, one is an 8 o'clock shift.
I mean, whatever it takes, I guess. But, listen, you got to do what you got to do.
Right.
But I laugh when I read these things because, these are things we've always talked about, maybe described a little differently, but these are things we've always talked about. But I have to tell you something. I've talked to, I say all the time on this program, I'm more of a listing agent than a buyer's agent. And I don't even know how many sellers sitting on the sideline waiting for something to change because they need to sell, have to sell, want to sell, upgrade, downgrade, move completely out of the city. But as you indicated before, that 3 and 4% interest rate is killing them because they know when they do sell and they go and buy something else, which they all will do, they're going to be paying a lot more. And on top of that, the monthlies lately, common charges or maintenance, real estate taxes if you own a condo, are extremely high. So, gone are the days where, and this is why I say purchase price these days doesn't really make that much of a difference to the buyers I talk about because they're kind of getting used to whatever our prices are, but they're looking at the overall monthlies.
Correct.
Which have accelerated by 10 or more. How do we get them past that? Because those are fixed costs, if you want to call them, that aren't going down. Maintenance is not going to go down. Real estate taxes clearly aren't going to go down, right? Interest rates may a little bit, but in the overall scheme of things, talking about buyer psychology, how do we get over that?
Yeah, it's funny. I heard from one of our agents the other day that they were showing one of their properties and the client who's not from New York comes in and asks if the maintenance ever goes down. Oh, honey.
No, the answer is no.
But I think the important thing for listeners that are not in New York to keep in mind is that the fact that our common charges or maintenance for our condos and co-ops have gone up is not a uniquely New York problem.
No.
In fact, it's true across the country and arguably many in Florida or other parts, have gone up even more than here.
Absolutely.
So that's important to know. It's not a uniquely New York problem. But yes, I think with everything else, we have to look at that total cost of ownership, that total monthly payment between principal and interest and carrying costs and taxes and all that, and look at that total cost and say, okay, from a budgetary perspective, do you have the income? Is it within that debt to income? Do you have enough liquidity to be able to support? And that's part of our job as advisors. And this is part of where I'm so passionate about we don't just sell real estate, right? The fact that real estate gets bought or sold is actually a byproduct of us doing our job, which is advising the clients and helping them to understand
100%.
What can they afford, what is realistic, what is good for them, how does it align with the Ds that they may need to achieve.
And on that note, and that's a very good point, and on that note, and we've talked about it on this program before, I've said for a couple of years now that, we as agents, we as the consultant and as the credible source have to learn how to better talk to our clients, to better negotiate with our clients, to better explain what's happening out there. Because honestly, Jared, I believe it comes down to us as the ambassador to that buyer or seller to make sure that they understand what is happening. Because we all know they can look at the news, they can read the news, watch the news on TV, whatever, and become horrified at anything. And so it kind of spins them into, whatever they get spun into. And that always affects the housing market. No, I'm not going to buy. No, I can't do that right now, whatever. It becomes our job to let them know that. Overall, the economy, one person says it's great, another person says it's not good. Is that really affecting the New York City? But we'll talk about the national market at one point, but the New York City marketplace, is the overall economy, whatever the perception is it hurting us or helping us?
I think there's not one perception anymore because, again, we're in that K shape where depending on your socioeconomic standing, depending on your job, the industry you're in, how much money you have, it's going to dictate how you're experiencing the market right now. If you're working on Wall Street, the world's great. Stock markets are going on 3 years of, very, very good returns. Bonus pool is going to be great. Real estate's been okay. But if you're a lower income worker, if you are in an area that has gotten a bit hurt by AI, some of the tech industry is seeing, layoffs and shrinking. So there's not a one size fit all approach right now. And even if you look at, the labor stats, we have a void of information. Yeah. And in some way, this is becoming a little bit politicalized as well, which is creating some confusion and mistrust. And again, that's all contributing into this multiple experiences. There's almost multiple realities that are equally true. Just depends on what side of the coin you're sitting on at that
multiple
time.
Realities. That's kind of something, isn't it?
Matrix.
It's like, okay, but when I referenced earlier, in our conversation, I didn't realize the number was so high, but as of last night when I was watching the news, 1 million jobs were lost in 2025. We don't have the November report yet. We don't have the December report yet. So I don't even know what that 1 million number becomes. So when we talk about affordability, when we talk about buyers out there or even sellers out there wanting to do something different in the real estate realm, if they're not working or if they just lost a job, what do we do with that?
Right. And this is where, and I've said this time and time again, politicians and those who have the ability to make change need to answer or address the hard question, right? We can't legislate prices to become less expensive because you cannot overrule the market force. That has not proven to be effective.
Cannot.
What we need to do is back to inventory, back to supply. We need to make it affordable to be able to build more affordable housing, right? There was a thing that was resurfaced about New York City is considered building micro apartments. So great. Let's build smaller, more affordable micro properties that give people the space that they need to be comfortable and doesn't break the bank. So let's be able to rezone.
I saw a photo of one of those micro apartments and I thought, okay, walk-in closet size. Okay. Yeah. Are they more affordable?
I mean, from a price per square foot basis, they're going to be roughly the same, but you're buying less square footage. So.
There's that word, square footage. We got to take a break. We're coming right back with more with Jared, and we're going to talk about 2026 right after these messages. Don't go anywhere.
Hi, I'm Dylan Pachulik, CEO of XL Real Property Management, New York's most trusted name in luxury property management since 2012. We specialize in managing individual apartments, townhouses, and rental buildings held by absentee owners. We maintain our properties with the highest standards of quality and service so that owners can choose a hassle-free approach to real estate investing. Rented or owner-occupied, we handle it all. For more information, contact us at xl-rpm.com.
All right, guys, we're back with our final block. So we're gonna Jared. Let's talk a little bit about how your impression, how we are going to end the fall 2025 market and what we see, as potential signals for 2026. So, what surprised you the most about this past season, which was September through now the end of the year, fourth quarter?
So you
mentioned it before. Higher contracts or larger amounts of contracts signed. What else?
That's my headline. It was headline defying, right? There was so much fear mongering leading up into the mayoral contest, talking about people fleeing, and the data didn't show it.
No.
But what's interesting is after last year's presidential contest, you actually saw a pop of activity afterwards because people had expected it to be a little bit contentious and drawn out. And as soon as it wasn't, again, like the results or didn't, as soon as it was definitive, there was a spike in activity, contract activity. So when you look at the year-over-year comparisons, Manhattan exceeded last year's for much of the fall and really until about the second week of November. And then it started lagging behind because last year sort of everyone held their breath and didn't act. And then after the results were in, there was this sort of catch-up. But there was no catch-up needed this year. We had this healthy level of demand, and we've been doing our thing. So I think the winter may be a bit quieter than last year because we're not experiencing that catch-up. We're just moving through this really steady pace. But I think the spring is going to be a really, really exciting time because sellers are going to see that there's been more activity and more demand because, again, the mainstream consumer is 6 months behind what's going on boots on the ground. So they're going to be able to experience that the market's getting better, and they're going to come to market. And we're going to have, wealthy people, bonus money out there. So, February, March, April, May, I think will be very, very healthy times for our market.
Which leads me into the luxury segment and how is that potentially going to shape the trajectory of, what's coming in 2026. Bonuses are big, as you said and indicated. People are going to be out there buying. Are they going to be buying in New York? Your opinion, or they're going to be buying that secondary home in the Hamptons and the Catskills or wherever else they may be buying. What is that luxury, market projected to be in 26?
So luxury has
it helped us in 25 for sure.
Luxury led the way this year. And November was the third best month, in the last 10 or 15 years in terms of contract activity for 4 million up. Brooklyn had an incredible month as well for 2 million and up. So the strength of the luxury, quite frankly, has overshadowed or hidden a little bit of the weakness in the lower price market that is more sensitive to interest rates. It is more sensitive to the macroeconomic forces. So luxury has been pulling more than its own weight this year. And I don't see that slowing down because, again, the energy is back in New York. And you have people that live here full time and want to own their primary residence here. And you have a handful, more than a handful, you have many handfuls of people who want to own a piece of New York as a secondary home or a tertiary home or, multiple properties. So there is a lot of demand still coming in here. And I believe you have people all across the age range that work on Wall Street are going to get these record-setting bonuses. You're going to have some of the younger ones that have been renting that now get to go and buy their first place. You're going to have people that may be in their, middle years with the family. Maybe they're going to buy something out in the Hamptons or in a vacation destination. Maybe they're going to trade up in the city because, again, they're less sensitive to the interest rates. They also have more creative ways to finance. There's been a ton of people taking liquidity access lines or other ways to be able to access funds that they have in their investment accounts without selling those securities for a lower rate than a traditional mortgage. And you may have some people who are at the tail end of their career that are going to go and buy elsewhere or invest elsewhere. So you have this dynamic makeup in New York across age ranges, across socioeconomic backgrounds. And again, there is something for everyone at every sort of time.
Cash still king?
Cash is still king.
I mean, it was in 25, and I assume that it's going to be next year.
Correct.
Talk a little bit about the rental market because the sale market over the last couple of years has been down.
Yeah.
and it was sort of booming this year, not as great as last year. But the rental numbers here in New York City are very, very high. Talked about all over the country, actually. What is your prediction for 26 on the rental market? As we probably ease more into sales getting better, do you think the rental market's going to pull back a bit, or is it going to continue to soar?
We got to talk about why the rental
And again,
market.
it's inventory. Go ahead. Yeah.
So rental market is more demand driven than inventory driven, right? Inventory matters, and we haven't seen as much new rental construction recently. Right. So we don't have as much new supply coming to meet it. But part of the reason that we've seen such a high increase in prices is that people have been staying in the rental market for longer than they ordinarily would have, meaning that people have made the decision to rent instead of buying because they wanted to not go illiquid. They wanted to keep their monies in the markets that were doing incredible things from a stock market perspective. They didn't necessarily know how long they wanted to own. People generally own their properties for less time in New York City than elsewhere because you buy incrementally by bedroom size because of how expensive it is. And people generally had a preference for being able to stay flexible. So you had people renting for longer than they would have otherwise. I can start now making an argument why buying is better than renting. If you have a 4, 5, 6, 7 year holding period, right? We're starting to see the early signs of appreciation. We're seeing interest rates dropping. We're seeing rates rise so much, especially on the heels of the FAIR Act that went into effect this past June. So I can start making that argument. And if more and more people are entering the purchase market, then that's some of that healthy sort of engine revving that gets that market moving upwards, and it pulls some pressure out of the rental market that can give a little bit of reprieve for pricing. And I think the other important thing is that people that took 5-in-1 ARMs, because people don't generally hold their properties as long in New York City as they do nationally. I don't have the stats for sure, but there is a higher percentage of the mortgages here that are that adjustable rate. So if you took a 5-in-1 ARM in middle of 2020, it's already reset. We're 5 years past that. If you took one in 2021, the bananas year, it's coming to be reset. So your interest rate arbitrage is gone when your rate resets, which means those people have some equity now in their homes if they bought early 2020 into 2021, and they can sell, make a little money, and trade up. And that again is another really important healthy engine of the housing market that gets more of the components or more of the participants firing at all cylinders. And when you get 3 or 4 of those cylinders firing, that's where you see this price increase. So I see us moving in that direction. Zooming out for those that have been following this market for a long time, I think we're back to about 2010, and we're entering the next wave of price appreciation. But I don't see us having that unhealthy, non-sustainable, wave that we had in 12, 13, 14, 15, where prices were going up 20% a year.
Incredible
But I see us moving back into a more normal, what's normal, 5, 6%, healthy sort of upward march.
And growing, from that point on.
That's correct.
So back to fourth quarter 2025, which we're in currently, are there any opportunities for buyers or sellers right now? And if so, where are they? Yeah. I mean, we talk about so many things, on their mind, whatever. Where might the opportunities be right now?
So we have
as we close the year.
We have a very interesting winter season right now because
it's cold today.
It's
very
cold. But oftentimes, again, we're back to inventory and supply. A seller that was on the market in the fall, and if they did not get their price, they would take the home off for a period of time and then relist it. And, everyone tracks days on market because days on market is an important equalizer in understanding where the leverage is between a buyer and a seller. Right. If you are a buyer and you've seen that a house has been on the market for 90 days, then logically you're going to say, well, why would I pay the asking price if no one else in the last 90 days have? So a seller only has about 2 to 3 weeks to be able to command their asking price before leverage starts slipping, because a savvy buyer is going to say, okay, it's been on the market, no one else has bid it. So I bring this up for an important reason, because it has traditionally been 90 days that a property would need to be off the market for the days on market count to reset on our RLS and on StreetEasy. StreetEasy made an important change earlier this fall where they said the property only has to be off for 30 consecutive days for it to reset. So I suspect that we'll see a larger than normal wave of properties coming off the market this time around the holidays, early January, because 30 days is a much shorter duration that you need to take your property off the market to get your days on market to reset.
I'm thinking that.
So this is going to create an interesting thing where you may see a supply squeeze more so than you otherwise would in the winter months, only for that supply to come back again. And this is why I'm very interested in tracking the amount of recycled new listings, meaning what property is coming to market like new, but is not really new. And more of the reason why you have to look at the history if you're looking on one of the aggregators to be able to see what has happened before and why you need a really good agent to help advise you. But having said that, if you're a buyer today and a seller is staying on the market during this time period, and that seller has been on for 90 days, and that seller has had 2 or 3 or more price cuts, that is a motivated seller. And that is an indication that they are most receptive to negotiation, and a buyer can do well. So,
correct. No, I agree with that. But what about the seller who says, I still want to enter the market first time at a very high price? Because, well, after all, and I still hear this, okay? Because after all, my neighbor, 2 years ago or 4 years ago, whatever, got that number. I'm actually dealing with somebody right now, a 2-bedroom, and they're $200,000 over what it will sell for. But because this is what people in the building in the past have gotten. After all, we paid very close to this too.
Yeah.
Now there's a need for them to really sell. Okay, it's not one of these wishful whatever, they have to sell, but they want to come on $200,000 more than it's going to sell for. And I keep saying, look. And it's a building I sell in all the time. So what do? Do you walk away from that? Do you take it? Do you start reducing? Will they reduce? I mean, we've all been there where, you get to confirm from the buyer, the seller, yeah, well, we'll reduce when the time is right or whatever. And then they say no when you go and ask them. So, here I am saying got to be a great negotiator, got to be a great, consultant, whatever. But sometimes it's difficult because the seller says, I can't do that.
So this is where I say it all comes down
Mr. Director, help me out.
Well, yeah, as a director here, one of the most frequent conversations I have with our agents is helping to price and helping them to explain to a seller why you may think it's worth X or you want Y, but it's not.
Right.
And the reality is a few things. One is, nothing can overcome an overpriced home. Nothing. Right?
No,
because
nothing.
Buyers are savvy and they're fearful of overpaying and they're not motivated extrinsically by FOMO. So buyers have so much information. They're not concerned about something running away from them. They're not concerned about interest rates running away. They're not concerned about prices moving higher. So they feel like they're in more control. So this doesn't give the sellers a lot of power unless that seller has a turnkey, beautifully renovated, properly proportioned home. In those situations, which makes up a minority of the inventory, but they have the majority of the demand because no one wants to do work today. It's gotten very expensive and very timely to do work. So some of the best values can exist with an unrenovated co-op where someone wants to buy it, renovate it, live in it for a while, or even just flip it, and that seller knows that they're selling at a discount. There's good value there, right? Because turnkey is being traded at a premium. But sellers need to be realistic. And an agent needs to be able to help advise a seller. And I've coached agents to say to Mr. and Mrs. Seller that, I'm sorry, but it doesn't seem like I'm the right agent for you today to help execute the strategy you want. If the market changes, if your strategy changes, you know where to find me, but I can't help you execute because it just doesn't work. If the price is too high, you're not going to get any interest.
This is always my strategy, and I've said the same thing. And sometimes it works, and sometimes, like this particular couple, they're still thinking. So I don't know how long that thinking process is going to take, but you're right. When you know the market's going to accommodate a price or a seller or what the seller wants, then great.
Right.
But when you know it's not going to, it really behooves us to kind of, dig in and say, hey, look, I may not be the right person to represent this at the moment, and here are my reasons why I'm telling you that.
And here's a helpful trick to turn back what you said earlier. When you look at what is the total cost you're spending every month to carry this place.
Right.
So, hey, if it takes you 6 months, a year, how much are you spending? Especially if you're privy to something going on in the building or an upcoming assessment. And, I use that angle all the time when we're dealing with estate sales, right? You have the heirs,
Correct.
the property's, empty. they're spending whatever money it is a month to carry it, and they want a certain price because that's what grandma said it's worth or whatever it is. And the reality is we explain, look, it's going to take you this much, you're going to spend this much money to carry it to try to get that price, or we can get you here. So coming down to that sort of net becomes a very important exercise in saying if you can trade time for value, you may ultimately not be as bad off as you're imagining.
I have one more for you before we go to close, and this is something that doesn't happen often, but it pops up every once in a while, where the seller is willing to reduce the price down to whatever it takes to get it sold. However, knowing the building is going to sit back and say the integrity of the price per square foot, and you can't do that, and it's going to set the bar for future apartments that are like that one, and on and on and on and on and on, and you're like, what? I get it. I get it from both sides. I certainly get it from the building's perspective because I have fought that in the past myself. Comment on that?
I hate it. Here's where I'll give a shout out to John Walkup. We were talking about this before the show of Urban Digs, and he wrote a really good piece in Forbes talking about like, sorry sellers, your home is only worth what the market's going to say. So to me, I think this is a must read for every property manager, every board member, and every owner of a property in the city. But it is asinine to me to think that a board can logically believe that if after a full public marketing of the property, right? Not some off-market or private listing network thing, but a full marketing of the property, which is in the seller's best interest, that we got this buyer, right? And this is the most that anyone was willing to pay for it. That they think that I can reject that buyer and then magically, out of the sky, some other buyer is going to fall and pay more is the dumbest thing I've ever heard. And again, I understand why they want to protect their values. I do. Trust me, I do. But it actually has the opposite effect because now your days on market is ticking up. Now you have more inventory. Now you've created friction to get in and get out of this building, which reduces the inherent attraction of it. So it undermines it entirely. I've seen buildings overly scrutinize and overly vet qualified candidates for no reason, right? So the problem is it is a diminishing return. I understand wanting to protect the sanctity. I understand wanting to make sure that the people coming in have the financial wherewithal to be a contributing member to the building. But the more you vet and the more you try to push and the more you try to override the market forces, the worse it's going to be for the building and for the prices.
And so we end on a conundrum, as we talked about earlier. It can go either way. I will clearly let you know how it goes because I've got two situations right now that pretty much keep me from sleeping at night. That's all we got right now. Coming back with my final thoughts. Don't go anywhere.
This beautiful set here at Studio 1873 is brought to you by the Everset. The Everset provides full-service staging and furniture rental solutions in the New York area. For more information, please visit us at staging.theeverset.com or email us at staging@theeverset.com to request a free proposal.
Okay, everybody, we are back with my final thoughts. As the rest of the country works through price declines and post-pandemic corrections, New York City continues to stand apart. Our market is being driven by fundamentals, steady job growth, global demand, tight inventory, and buyers motivated by real-life needs, not speculation. Migration patterns are normalizing, the Northeast is regaining strength and luxury, and all cash segments remain anchors of stability. While many boom markets unwind, New York City is showing resilience, balance, and growing confidence. Heading into 2026, inventory, not interest rates, will be the variable to watch, but the outlook remains positive. In a national landscape full of noise, New York continues to be the exception and one of the healthiest markets in our country. And that's our broadcast for today. Thanks to Jared for being here on set with me. You can follow me on Facebook, on Threads, Instagram, LinkedIn, Blue Sky, Substack, or TikTok at Vince Rocco. And Vince Rocco does say the world feels loud right now. The noise, the markets, the uncertainty, it's all moving fast. So stay calm, stay classy. And from all of us here at Talking New York Real Estate and the More Network, to all of you all around the world, thanks for spending a part of your day with us. I am grateful. Keep thinking the good thoughts, and I will see you next time. Goodbye, everybody.